Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Tiger Williams, founder and managing partner of Williams Trading. So tell us a little bit about Williams Trading. What does your company do, Tiger?
So Williams Trading is a company I founded in 1997, and we get credit for being pioneers in the outsourced trading model. Outsourced trading model is when a client either decides not to have an internal trading team or has a small trading team. And when I was at Tiger Management previously, a number of the analysts had left. They didn't know anything about trading, started their own firms. So I left Tiger in 97. I had 6 partners as clients, my original clients, and subsequently launched Williams Trading with 2 other traders. So we are known as sort of the independent outsourced trading firm, but today we're really more a specialized financial services company. Our bread and butter is trading equities, equity-led derivatives, and futures. We also do some investment banking and a little bit of research.
So why do these hedge funds, you trade for some of the biggest hedge funds around and have for all these years, why do these hedge funds trade through you as opposed to setting up their own internal trading operations?
Well, the first thing we have to do is be careful about clients. We have very strict confidentiality documents, so we're not going to name clients. What I've done is build a team of exceptional traders, and as a result of that, our currency is trust. And they trust us to be forward-thinking and look out for their best interest in the immediacy world of equities. Subsequently, we're anticipatory of their needs. We tend to know the portfolio managers, the analysts, the risk managers, the chief of compliance, and they come to us with a variety of questions, some very easy and some very random. And then we find the answers and package them in a way they're accustomed to. So as a result of that, they trust us to be forward-thinking for their questions. And they rely on us to get them best execution, and that's worked.
So in other words, you guys have maybe the best trading just in terms of speed, execution, pricing, and you're also a place that's known for being sort of a crossroads of information on Wall Street. I mean, you know about deal flow and what's going on with market participants, right?
That's correct. So think of us as being a bit of a hub, and we sit in the middle of a delicate balance of all the different investment banks, research boutiques, and subsequently that information, their research, their flow, their opinions flow into our room. We then distill that information down into sound bites that our client base cares about and deliver that to them in a time and a way that they add to their investment strategies or trading decisions.
Right. I know you can't really talk about the names of these clients too much, but can you sort of tell us maybe an emblematic story of a situation where a client asked for something, or you helped the client out, or you discovered something that was particularly useful?
Sure. I mean, we tend to know our clients extraordinarily well. And because they trust us, they share with us their portfolios. Subsequently, the majority of our hedge fund managers are long-short managers, so we know what their shorts are. And as a result of knowing what their shorts are, which are not in the public domain, we can be forward-thinking against a short squeeze. So that when the stars align in a short squeeze and stocks start to really move, like a GameStop, an AMC, there's been others, there was one in Volkswagen, things like that, we then read the tea leaves and go out to the community and see the patterns and share those patterns. We don't get paid to give people directional advice, but we would call up and say, hey, I see you're short GameStop. It's starting to set up and look like it might be a squeeze for a variety of reasons. We would suggest you cover it. If they decide so, great, we get credit. If they don't, that's okay too. But that's a pretty good example of how we collate and collaborate with our clients to, especially in the short side, to keep them out of harm's way.
Right, and a short squeeze is when the stock goes up
a lot,
and it will burn the short sellers, and they all have to.
Well, they'll be forced to cover.
Right. And you hear about people, Tiger, talking, oh, I'm going to short this stock, and you see a stock that went way down, and people say, oh, I wish I shorted that stock. Is shorting stocks easy to do?
No, shorting stocks is actually, first of all, you have unlimited liability. So for simplicity, if you buy a stock at 10, it goes to 0, you lose $10. You short a stock at 10 and it goes to 50,000, you lose 499,000. So unlimited liability will wake you up at night. That's one. Second is you've got to secure a borrow in it. You've got to borrow it from a prime broker, and there's a limited supply of what's available to borrow. Without a borrow, you can't short it. Third of all, you've got everybody else in the world cheering against you because the world likes to see stocks go up. And I get that, your 401k, the employees and all that. So it is a very harrowing and challenging vehicle that the majority of our clients believe is a necessary component of their investment strategy. So we tend to work with these guys very closely in the short side.
Right. Long, short hedge funds is what
Yes.
you're talking about here. So let's shift gears a little bit, Tiger, and let me ask you about the market outlook, what you see in the equity markets in 2025, a little bit longer term horizon. And are you very much top down like that? Are you only bottoms up? How do you see things?
We wear multiple hats. We look at the markets through as many lenses as we can. The initial reaction for 25 has all been Trump. Trump won. Trump ran on a variety of promises, and he's very rapidly, I think it's a month since he got sworn in, a little longer, executing on what his promises were. With that, that's given a sense of uncertainty into the marketplace, well documented. Then we have the interest rate game. Jerome Powell is on TV a lot. He's indicated the mandate of the 2% target in inflation is something that he believes is achievable and it's moving in the right direction. Some of the shorter term information around employment, around just trying to get a reservation at a restaurant, or if you fly on JetBlue like I do, it's sold out, suggests that that's going to be a challenge. So those things are very well known in the market. What has been unique for me after doing it for a long time is the volatility of the overall market, what we call the VIX index, is sort of in the mid-teens. It seems fairly placid. Stock volatility around earnings has been exceptional. So into the earnings, there's a lot of action. After the earnings, if a company makes the quarter and guides higher, the stock tends to rocket. If they make the quarter and they guide lower, the stock tends to plummet. And you see these massive moves in stocks with huge amounts of volatility for a short period of time. And I think that's going to continue. And I think that's not in anything that shouldn't have come. We like that stuff. Our clients tend to be very, very robust bottom-up stock pickers, and the ability to take advantage of the volatility in individual names while the index is more placid is pretty compelling.
Why do you think there is that volatility with specific issues like that, though?
That's a complicated answer. The simpler answer is that you have multiple audiences. You've got a high-frequency audience as a high-frequency trader. You've got a much larger participation from retail investors. You've got quantitative investing. So when you bring all these different components to the marketplace, they have different mindsets, and subsequently you just see volatility. Stocks will report the quarter after the close, and they'll move 10, 12, 15%, and they tend to settle. But it's really just a reflection of all the different players coming into a specific name around an event, the earnings, and subsequently the machines, the algorithms, et cetera, being a magnifying glass to those moves.
Speaking of machines, that's a big theme too, Tiger, this active versus passive investing. And obviously passive investing's gotten way bigger over your career. Has that really changed what you do?
It's just an important component. So our audience, our clients really tend to be single stock pickers, and then they use the indexes to hedge as an overlay. So with it, what we try to do in the trading arena is distill how much of the movement in an individual stock has to do with it being a large component of an index. Because when someone buys that index, subsequently you'll see demand in that individual stock that may have nothing to do with the specific fundamentals or technicals of that particular stock. And they move a lot. So subsequently, that could be 30 or 40% of the volume in a particular stock in a particular name directionally. And subsequently, it's our job to sort of disentangle that and pass that on to our client, who calls up and says, fundamentally, I'm long it, and it's up a lot more than I thought for no reason that we can see. No change in research, no change in data. And a lot of it ties back to how active it is in the index, what's the weighting in the index. So it's a major component because the indexes are probably 30% of the volume today.
Right. Speaking of being in the business a long time, pricing in stock trading has gone like that, right? I mean, hasn't that been a huge wind in your face, and how have you mitigated that?
Well, if we go back to the dark ages of 1987, I started my career on the floor of the New York Stock Exchange in 1987. October 19th, the market crashed. I think it was 504 points, traded about 600 million shares. Today, public equities trade around 15 billion shares a day, and there are single stocks that trade 1 billion shares. So subsequently, as you've seen volume literally explode, it's only logical to think that there'll be margin pressures on commissions. So with it, what used to be a standard commission is probably 70 or 80% lower, but the volumes have made up for that significantly.
Right. You mentioned Tiger Management, which was run by Julian Robertson. You worked there. And I might as well get this out of the way. Your name is Tiger. You worked at Tiger. Do those two things have anything to do with each other?
It depends on who you are. I was fortunate enough to play hockey at Yale. And when I got to Yale in 1980, hockey is a big nickname sport. And there is a very notorious original David Tiger Williams. And he was in his heyday in 1980. He was the most penalized player in the history of the NHL. And when I got to Yale, they said, your nickname is Tiger. And that was 1980. And I said, sure. So with it, I met the team that runs Tiger Management in 1991. They hired me in 1993. And, Tiger was founded and owned by Julian Robertson. He named the firm Tiger because he had this amazing brain to remember stocks and information, but he wasn't great with names. So he would just, instead of saying, hey, Andrew, he'd just call you Big Tiger. So he loved the nickname Tiger. I got to be Tiger at Tiger. There was some confusion with people who have smashed me and the other guy together, which just isn't true. I did not play hockey at Yale and graduated in 84, come to Wall Street in 87, and amassed 4,000 penalty minutes in the NHL. But the nickname stuck, and Julian liked to yell, hey, Big Tiger, a lot. So that's where it came from.
And so what was it like? I mean, that place spawned so many legendary hedge fund managers, all the Tiger Cubs, and you were there on the trading desk. What was that environment like? And then it blew up. It did great, blew up.
Yeah, when I got to Tiger Management, think of Tiger Management as a pyramid structure. Julian sat on top of the pyramid. He made all portfolio decisions, all capital allocations. The analysts, affectionately known today as the Tiger Cubs, are broken down by industry, and they would bring Julian ideas in their industry. And Julian relied on them very heavily. They would do an amazing amount of fundamental work. They would pitch an idea as a long or a short. Julian would then go through a process that was very instinctual to him, and then he would make those decisions. Then he'd come out and he'd literally say, hey, Big Tiger, buy or sell a couple $100 million worth of this. Julian was a believer that he could bring the best out of individuals, and that Andrew Serwer, the tech analyst at Tiger Management, had a certain amount of best names, and his job to ask probing questions to get the best out of them, and then it was his responsibility to create the portfolio, to manage the risk. And subsequently, you had to speak Julian. So anecdotally, it's my third day. And Julian comes out the desk, and he goes, Mad Dog. I'm like, Mad Dog? He goes, cover the dog. And he woofed at me a little bit. So I see on our sheet that we're short 2 million shares of McDonnell Douglas, which is what Julian called Mad Dog. I said, okay, Julian, I'm going to cover the 2 million shares of McDonnell Douglas. And we were short them, I don't know, 30 or 40 bucks. It's trading at 80. And he goes, I want to take them off now. And I moved this stock $10 on my third day. Got us out of 2 million shares of McDonnell Douglas. And I went, he's going to fire me. This is the worst thing ever. Then he came back out and he said that was fabulous. And we ended that year up 100%, while the S&P, I think, was up 7 or 8. He was a man of great conviction, was a consensus guy, really believed in team. He ran an incredible place to learn and grow and gave people a lot of responsibility and opportunity, and I'm incredibly appreciative of it.
Do you try to do some of that stuff at Williams Trading?
A little bit. We really believe in the team sport metaphor. So as a result of that, there's a number of things culturally that we do to try to bring the best out of individuals to advance the team. Because when the team is strong and the brand is strong, then we can really be much better partners. We look at partnering with our clients. And in the process of partnering with the clients, they then refer us to more clients. So everything is based on team. Our reward structure is based on team. Our lifestyles are based on team. And that really was lessons that Julian taught.
Right. Did you ever have to fire a client, Tiger? Is there going to be people who washed out? And can you tell the story without naming proper nouns?
Well, what we always want to do is to help our clients be the best they can be. But if there are people who are just constantly looking in the rearview mirror and constantly negative and constantly accusatory in a way that is inappropriate and unhealthy, then I will call them and say, listen, it's clear to us that somehow we're inadequate for whatever it is. And you have to think about traders. Traders tend to be human piñatas. And when things aren't going well in the portfolio managers call up and beat up on traders. And we get that. We are thick-skinned. We understand that. But when the mentality of that client is derogatory, accusatory, or negative, we part company. We don't do it a lot. And then, we've come across situations where they've been in times when maybe their edge is a little too sharp. And if it feels a little too sharp, we part company. Got it.
What about regulation? What's the right amount of regulation? How would you be able to tell for your business?
That's challenging. I'm a bit of a libertarian. Williams Trading is a registered broker-dealer, registered and supervised by FINRA, which is supervised by the SEC. There is a phenomenal amount of regulation. I understand the purpose of that is to protect the individual investor, or perhaps an unsophisticated investor. None of our client base would fall into that category. So we've seen layers and layers and layers of regulation come into the marketplace in the last few years. That regulation has made going public a challenge, mergers and acquisitions a challenge. And I just don't think that that's a great mechanism for capital formation and great ideas to be turned into great businesses. So a little less regulation than we have today. But certainly we need basic regulation, to keep fraud and corruption out of a system.
Right. And what about retail investors getting into private market securities? That's a huge trend on Wall Street right now. And obviously the private equity guys say it's the greatest thing and they should be allowed access to it.
My old partner and boss, Gil Caffrey, used to look on the trading desk and say, be careful what you wish for, you may get it. The real challenges of private equity, whether you're an institutional investor, is that you have to be in for the long haul because you never know if you're going to have a liquidity event. So company A that's private versus company B that's public, company B that's public, you can get liquidity at any time. Company A to get your money out to sell your shares is very difficult. That lack of liquidity is a very large component of risk that really hasn't seemed to be baked into the private equity model. And because that's real risk, having individual investors who might not be sophisticated, who might need that capital involved, creates, I think, an awkward set of circumstances. What have been created is some special purpose vehicles that allow small investors to invest smaller amounts of dollars because they're not qualified investors to be in private equity. Those are very popular now. They tend to be at very aggressive fee structures, aggressive in a way that I think is excessive. Subsequently, between fees and lack of liquidity, I don't think having individual investors in private equity is the greatest idea. But again, I'm a bit of a libertarian, and if there's a demand, there will be a solution created.
Right. And final question, Tiger, I want to ask you about technology and how that's changed what you've done over the years, and in particular right now. Are you using AI? What's sort of the latest in terms of technology and stock trading?
So again, back in the 80s, stock trading was voice. A guy from a trading desk called a clerk on the floor, me, who wrote something in terrible handwriting on a piece of paper, handed it to a floor broker who walked out to a specialist. They made a trade, walked back. And back then you had 90 seconds to execute a market order. Today, most market orders are traded in 3 milliseconds.
3 milliseconds?
Yes. By comparison, the fastest thing a human can do is blink, which is about 20 milliseconds. So technology has created a massive acceleration in speed. And when you go from 90 seconds to 3 milliseconds, I don't know how you do the math of it. Nothing else in the world has changed in speed, right? The car drive home, the plane ride to Europe, your time for running a mile has nothing like that. So everything happens extraordinarily fast. And that's a result of technology. And speed, when things get messed up, can create a phenomenal amount of disruption, and that disruption is risk. So with it, the technology has created a level of complexity in trading that is so mind-numbingly boring, I won't get into it. But with it, there's complexity to how retail orders are entered with payment for order flow, how you can enter an order with different exchanges or use dark pools. But technology, I'm never a believer of trying to restrict the advancements of a technology. You have to accept it. It's a bit of trial and error. We rely heavily on technology. And the simplest metaphor is that, if you use a Top Gun metaphor, Tom Cruise isn't actually flying that F-16. The computer is, and he's giving the computer instructions. That's what a trader does today. You give the computer and the algorithms and the system's instructions, and the computer very, very quickly follows those instructions. It enables a much deeper and larger pool of liquidity, but it does sometimes create volatility, but you can't get in the way. As far as AI is a little tricky because that's the beauty of what's happened is we've taken something very complicated, very broad-based, and distilled it down to 2 letters, A and I. A and I is just a combination of machine learning, large language models that layers enough data into a system that you can use that machine to help you as a human make decisions, or perhaps at some point replace you. And what our clients do, they're beta testing it to see if it actually adds value. But there's not currently enough data that you can distill fast enough that isn't arbed away by just normal investing mechanisms. So AI is coming. I think AI has a role. I don't think it's as large in investing as it will be in healthcare or in education, but it has a role. But in the end, there is someone who is going to be making those decisions with a lot of tools that I don't think is going to be replaced.
Fascinating. Tiger Williams, head of Williams Trading, thank you so much for joining us.
Thanks for having me.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.